Saturday, November 16th, 2019, Maneco 64, home of alternative economics and contrarian views. So you'd think the US economy was firing on all cylinders, right? GDP booming, unemployment at record lows, stock market closing at all-time highs yesterday. The Dow closed up over 200 points, above 28,000. But what if I told you that actually the US economy is coming to a grinding halt? And it actually is. And that's not me telling you. That's the Atlanta Fed coming out after the data that came out yesterday and revising their fourth quarter GDP forecast to almost zero. It's now down to 0.3. So what's going on here? How come the stock market is soaring? The economy is coming to a grinding halt, almost to zero, right? And we probably will see them revise this even further down depending on how the data come out in the next few months, right? Well, my opinion is that we're seeing a crack up boom. We're seeing like a flight to safety, a flight away from the dollar, and the flight away from the currency, right? And that's what a hyperinflation is. Hyperinflation is not caused by a strong economy where prices start rising, right? Hyperinflation is a loss of confidence in the currency. It usually happens when an economy is in a recession or depression, right? And before I go a little further into the Atlanta Fed's forecast, I wanted to show you a few charts of what happened in countries where we've had hyperinflation. Of course, the most famous hyperinflation is the one in Germany, the Weimar Republic hyperinflation after World War I in 1923. So we've got this chart, which I've looked at in the past in this channel, maybe a year or two ago, to show people that the stock market actually does well in a hyperinflation. So here we go. It's actually from JP Morgan, the source, The Economics of Inflation by Constantino Bresciani Turoni. So German stock market in marks and US dollar. So in the left-hand axis, you've got the prices in Reichsmarks, right? Or marks. In the right-hand side, you've got US dollar prices. Don't forget, in 1923, the dollar was gold, right? It was as good as gold. $20.67 was 1 ounce of gold. So as you can see here, the German stock market made a top, was topping for about, a bit like the Dow and the S&P have done for about 2 years there, around 1,000 marks, right? As you can see. And all of a sudden it was making new highs towards the beginning of 1923 and went from under 1,000 to 10,000, 100,000, ended up at 10 billion, even above 10 billion. These numbers are so huge, right? But as you can see in dollars, it didn't do as well. It had topped around 20, right? It dropped to almost 2.5. And eventually, when the hyperinflation came and it ended, it was at around 27. So it protected people against the hyperinflation. And why is that, you might ask? Well, because you're not holding the currency, you're holding claims to companies, right? Preferably non-financial companies like insurances and things like that. More industrial companies involved in the real economy, right? So that was Germany, 1923, early 20s, Weimar. And then we've got a more recent event of hyperinflation, and that was in Venezuela, Caracas Stock Exchange Index. And this is from FactSet, the source. It says Venezuelan stocks are surging amid the crisis. So I would argue the same thing is happening in the US. Stocks are surging amid the crisis. And I'll come to that in a minute, to the crisis. So there we have it. same thing here from around 2015 to towards the end of 2017. We saw a top in the Caracas Stock Exchange, and then all of a sudden it picked up and just zoomed from under 20,000 to over 100,000. So, of course, the Venezuelan Bolivar, the Venezuelan currency went down the tubes, right? But holding real assets through equities was not a bad thing. So what about the crisis? Well, I would argue that the crisis is the repo crisis that has been covered up, right? First of all, and the new QE that's not being called QE, right? The repo crisis appeared back in September, where overnight rates went up to 10%. The repo market is where financial institutions lend money to each other with and use treasuries and other related securities as collateral, right? So these financial institutions were not willing to lend to each other overnight, not even for 10%, right? Or for 10%. So the Fed has had to intervene. They've announced also QE, 60 billion a month, which they said is not really QE, right? And they're doing, I mean, we're losing track now of how much repos they're doing, but I think it's over 200 billion now in QE. And recently, they've just announced again on November 14th that they're going to do another 3 term repos. Of course, repos, you got the overnight repo, and the term repos are like a little longer than overnight. They could be 2-week term repos. So this is not me making this up. This is from the Federal Reserve Bank of New York, who is in charge of doing all these operations. They say the open market trading desk at the Federal Reserve Bank of New York has released the schedule of repurchase agreement repo operations for the monthly period of from November 15th through December 12th, 2019. In accordance with the most recent FOMC directive, the desk will continue to offer 35 billion 2-week term repos and at least 120 billion in daily overnight repo. Got the 60 billion in QE, so that's way over 200, right? And now it says the desk will also offer 3 additional term repo operations during this calendar period with longer maturities that extend past the end of 2019. These additional operations are intended to help offset reserve effects. Well, all the jargon, right? Arcane jargon that they give. So this is the crisis, the repo crisis, right? They've had to cut rates 3 times, and now you've got the Atlanta Fed. So let's go over the Atlanta Fed. Federal Reserve Bank of Atlanta Fed GDP now estimate for 2019 Q4. There's the evolution of their forecast. This is where most people are forecasting. Their blue chip consensus is just above 1.5%. You can see the Atlanta Fed estimate now is 0.3%. And the latest numbers that made them change this were numbers that we saw yesterday, retail trade and industrial production. I'll show you that. So retail sales came out, core retail sales came out at 0.2, was expected 0.4. Retail sales ex autos and gas was 0.1, it was expected 0.4. You see that capacity utilization dropped by almost 1 full percentage point from 77.5% to 76.7%. Is that really an indication of a booming economy? No. The Atlanta Fed is right to revise their forecast lower. Industrial production, previous month, as you can see, was down 0.3. This month was expected down 0.4, but it came out down 0.8. And industrial production dropped over 1% for year on year. And then you've got manufacturing production as well, down for the last 2 months. It did come out in line, minus 0.6. That's the feeling I get. We're seeing a rush away from the currency. What about precious metals? Precious metals, of course, didn't do very well yesterday. I think gold closed around 1468, silver just around 17. They will pick up, believe me, they will. With what's going on now, I think that's a flight away from the dollar. Hyperinflation is not related to cost push inflation, the kind of inflation that people talk about when the economy is strong, right? And you get labor demands for higher wages. They say that that creates inflation. Of course, we know inflation is purely a monetary phenomenon. What I think is happening is that investors, and these are the people in the 10% because they own most of the assets out there, right? Most of the so-called wealth, paper wealth. They're concerned, I think, about the central banks. We've even had in Europe central bankers criticize the ECB for their policy of negative rates and more QE. People are questioning whether negative rates are really beneficial to the economy, seeing that pension funds and insurance companies need to have an income of around 7 to 8% to cover their liabilities. So, as Alan Greenspan said a few years ago on national television, yeah, the U.S. might not default because they have the U.S. has the ability to just print, right? So there won't be a default. What there will be is a destruction of the currency. So, yeah, you will get paid your social security or whatever the government owes people. People will get paid, but it won't buy as much. And I think the stock market is showing us signs of that. Of course, I'm not saying I'm 100% right. And I actually dispute anyone who says they've been right the last few years about what's going on. I just think that we need to keep that in mind. So what do you do in this situation? Well, try to get rid of as many Federal Reserve notes as possible, which is nowadays known as dollars, right? And I think that's what the top 9% or top 10%, especially the 1%, that's what they're doing. They're getting away from the dollar. They're getting into equities. They're getting into hard assets, tangibles. And in the 1920s, in 1923 Germany, when the mark collapsed, yeah, the very rich were okay. The bottom 50%, if you didn't have any protection, like if you didn't have any dollars or sterling at the time, your savings would have been wiped out. And I think this is where we could be going right now. And yeah, don't get fooled by the mainstream media saying that everything is great. And hyperinflation comes like a thief in the night, so to speak. It happens very quickly and it ends very quickly, and most people won't know what happened. And it's got nothing to do with the normal CPI, right? I know the number is around 2%, but nothing to do with it. It's the loss of confidence in the currency, and the demand for the currency plummets. What does that mean? Well, people don't want the currency anymore. They want anything but dollars or pounds or marks, right? So that's my view here for the day. If you enjoyed the video, make sure you hit the like button, subscribe to the channel if you haven't yet. Make sure you hit that little notification bell above as well to be notified of all my new videos. You can also follow me on Twitter, Steemit, and on DTube. And yeah, I hope you all have a great weekend, and I'll talk to you later. Take care. Bye.